Okay, I want to tell you a story. And this is a true story that, honestly, it just shouldn't make any sense. It's about how a simple, everyday janitor managed to build an incredible fortune while at the same time a top-tier, Harvard-educated executive lost absolutely everything. This isn't just a fun anecdote, it's a puzzle, and the answer reveals a really powerful truth about how money actually works.
So, let's meet our two main characters. On one side, you've got Ronald Reed. He spent his life fixing cars at a gas station and sweeping floors as a janitor. A life of manual labor, you know? Quiet, steady. And on the other side, we've got Richard Fuld, Harvard MBA, a titan of Wall Street, the CEO of the massive firm Lehman Brothers. Now, logic tells you exactly who should have ended up richer, right? But, as you're about to see, when it comes to money, logic can be surprisingly misleading. When Ronald Reed passed away back in 2014, the world finally learned his secret. Get this, this humble janitor had a net worth of $8 million, all quietly built up over a lifetime of just saving and patiently investing the little bits of money he earned. And Richard Fuld, well, after the 2008 financial crisis, Lehman Brothers just imploded. Fuld lost his job, he lost his reputation, and he lost his gigantic fortune. His high-flying path came to a crashing halt in bankruptcy. So this is the big question, isn't it? How on earth can a regular person with a regular income build extraordinary wealth, while a supposed financial genius with every single advantage ends up with absolutely nothing? Well, the answer has nothing to do with how smart you are. And here it is. This is the key. Financial success is less about what you know, the complex math, the spreadsheets, and it's way, way more about how you act. It's not a hard science, it's a soft skill. And it turns out Ronald Reed understood this psychology perfectly, while Richard Fuld, for all his brilliance, well, he just didn't. Okay, so let's break down the first piece of the puzzle here. This was Ronald Reed's secret weapon, the incredible power of compounding. See, it's not about earning a ton of money all at once. It's about giving your money a ton of time to grow. And if you want to see compounding in action, there's no better example than Warren Buffett. Check this out. It's just staggering. A full 95% of his entire net worth was earned after he turned 65. Think about that. His real superpower isn't just being a smart investor. It's that he's been a pretty good investor for an unbelievably long time.
And this is the exact same game Ronald Reed was playing. He wasn't some genius stock picker. He just saved what he could, put it into solid, blue-chip companies, and then he did the hardest part. He just waited. For over 40 years, he let time and compounding do all the heavy lifting for him.
But you know, patience is only half the battle. This whole story reveals something super important. Getting rich and staying rich are two completely different skills. Richard Fuld was a master at the first part, but he failed catastrophically at the second. And this is where so many smart people mess up.
Think about it. Getting wealthy, that usually means taking some big risks. It requires optimism, putting yourself out there. But staying wealthy, that requires almost the opposite. It requires a little bit of fear, a bit of paranoia, and a constant focus on just not losing the money you've already made. The skills are practically polar opposites.
I mean, look at the tragic story of Jesse Livermore. He was one of the greatest stock traders who ever lived. During the 1929 market crash, he made what would be billions in today's money. He was an absolute genius at getting rich. But just 4 years later, he'd lost it all, declared bankruptcy, and tragically, he took his own life. He just couldn't stay rich.
So how do you manage that risk? Well, it's about understanding the power of what are called tail events. These are the rare, super high-impact things that happen. The crazy thing is, you don't have to be right all the time. In fact, you're probably going to be wrong or just kind of average most of the time. Just look at Buffett's portfolio. He's owned over 400 different stocks, but check this out. Just 10 of them, 10, generated almost all of his wealth. A few huge, massive wins pay for all the little losses and the mediocre bets.
And the only way you get to experience those huge wins is if you stick around long enough for the odds to finally tip in your favor. And that's what it all comes down to. Survival. Just being able to endure the ups and the downs, the crashes and the panics, that is the single most important skill in all of finance. Okay, but if survival is so crucial, why is it so hard to just stay in the game? Well, it's because our own brains are often working against us. So let's look at some of these invisible psychological traps that cause even the smartest people to make truly terrible financial decisions. One of the biggest traps is this one, the man in the car paradox. So, when you see someone driving by in a Ferrari, you might think, wow, that guy must be so cool. But let's be honest, you're not really thinking about him. You're actually using that car as a prop for your own imagination, thinking, man, if I had that car, people would think I'm cool. And this kicks off a really dangerous cycle. We start craving that respect and admiration we think we'll get from owning fancy stuff. And that desire pushes us to take stupid risks, like leveraging everything we have for something we don't actually need, which of course can lead to losing everything we actually have.
This is basically the story of Rajat Gupta. I mean, this guy had it all. He was the CEO of McKinsey, one of the most prestigious firms in the world. He had a net worth of $100 million, but it wasn't enough. He wanted to be a billionaire. And that burning desire for more led him to commit insider trading. He ended up losing everything: his money, his reputation, his freedom. He went to prison.
And all of this leads to this brilliantly simple formula. We think building wealth is about jacking up our income, but it's actually way more effective to just shrink your ego. Because wealth isn't the money you spend. It's the money you don't spend. It's the fancy car you don't buy, the designer watch you don't wear. True savings. They come directly from taming that part of your ego that wants to show off.
So, what's the big lesson here from the janitor, the CEO, and all these psychological traps? How do we actually apply this stuff? Well, it all comes down to one big idea. You have to play your own game and completely ignore everyone else's. It really means taking these core ideas to heart. First, know that your patience is a superpower. It lets compounding work its magic. Second, your number one goal is survival. Just don't get wiped out. And finally, and this is probably the most important one, you have to define what enough actually means to you. You got to stop moving the goalposts and stop comparing your life to the person in the fancy car.
Because at the end of the day, the goal isn't a bigger house or a faster car. That's just the stuff that shouts the loudest. The real goal, the absolute highest form of wealth, is having control over your own time. It's freedom, the ability to do what you want, when you want, with who you want.
And that kind of leaves us with one final question for you to think about. When you look at your own financial goals, what's their true price? Is it just the money? Or is it your peace of mind, your freedom, your reputation? Knowing the real answer to that question, well, that's probably the most important financial decision you'll ever make.